Okay, welcome everybody. Thank you so much for joining us today. My name is George Dyer. I'm the Executive Director of the Intentional Endowments Network. We'll go to the next slide. I am joining today from Essex, Massachusetts, just north of Boston. And this is the ancestral land of the Pawtucket people. And as we recognize Indigenous Peoples Day this week, and as we think about the history of genocide and oppression in our country and in our economic system, we recognize that a lot of these same drivers of extraction that led to taking land and enslaving people are also driving the climate crisis in many ways. So as we talk today about solutions to the climate crisis, I think it's important that we keep that broader context in mind. Next slide. For those of you who are new to IEN, we are a nonprofit peer learning network. We hold events like this, put out publications, resources, have working groups, and all kinds of activities. So if you have not yet participated in the network, or if this is your first time, please be in touch to join and learn more. Next slide. And a major element of this work within the network is around climate change and climate risk in the investment process. And recently, a lot of that conversation has focused on the concept of net zero portfolios. We've got an initiative on this topic led by a diverse steering committee. We released a briefing paper over the summer designed to get this conversation started with your boards or colleagues. So please check that out, or again, be in touch if you'd like to learn more beyond our conversation here today. And one of the key conversations or topics that keeps coming up in this conversation is around carbon footprinting of the portfolio. So that's what we'll be focusing on today. Questions about how do you do it? How useful is it? Can you get the data you need? Is that data any good? And can it unintentionally lead to sort of ineffective strategies around shifting to a low carbon economy, or what are some of the pitfalls and challenges around that? So next slide. And I'm thrilled today to be joined by two of our members of the Net Zero Steering Committee, Ariane Devine, who is Global Head of Asset Owner Strategy at ISS, and Jeff Minlin, who is the Chief Investment Officer at ASU Enterprise Partners, which houses Arizona State's endowment. So next slide, just a quick one on logistics. I'm sure everyone knows by now, please enter your questions into the chat at any time as we're talking. No need to wait till the end. And we'll get to as many of those as we can as we go through this session. And this webinar will be recorded. So if you have colleagues you'd like to share it with, or if you'd like to go back and check it again afterwards, that'll be available probably by tomorrow. So with that, I'm very pleased to hand it over to Ariane to get us started, to set some of the context on the importance of addressing climate change in the investment process, and kind of an intro on carbon footprinting for the portfolio, around why it's important, how it's done, and what are some of the challenges. Ariane?
All right. How much time do I have? Anyway, thank you very much, George. And thank you very much for having me here. I do look forward to speaking here to the IEN membership on a topic I care deeply about. Before getting to carbon footprinting, I find it's helpful to properly understand the enormity of the challenge we're facing and the urgency to act. And if I can ask you to go to the first slide, please. Next one, please. Many of you will have seen these kind of scenario slides, which look at different temperature rises based on the amount of annual CO2 emitted. And what you see, on the x-axis here, the total global emissions, and the y-axis, the years. Even under drastic measures, we're looking at best to keep temperature increases to 1.5 degrees Celsius or 2 degrees Celsius by 2100. And if we think about it, since 1880, we've already experienced 1 degree Celsius increase in temperature. Now, to stay in a range, no further CO2 should be emitted past 2050. And that for investors has implications. You are running a financial risk to the extent that you have exposure to high emitting companies, especially those who may not be on a pathway to change. But B, also you have the opportunity to not only reduce this investment risk and allocate to opportunities, and we'll talk hopefully a little bit about that as well, but at the same time also contribute to a better future for the next generations, which includes the students. Next slide, please. But let me put this into a slightly different context to highlight the sense of urgency. And here we're looking at a world population growth chart. We've created this problem over time by enjoying the benefits the Industrial Revolution and other advances brought us without understanding the costs or externalities. You know, it took us 125 years to increase population by 1 billion. The next 3 billion in population growth only took us 60 years to 1987, and the next 2.7 billion in just over half that time, again by 2019. Not only can we no longer ignore the externalities, at this point we have to decarbonize to provide for a reasonably stable future. And there's a lot we can do. And really the first step, and now we come to the carbon footprinting, the first step for institutional investors is to understand the carbon footprint and the carbon emission intensity of their portfolios. As an investor, you do want a baseline of where you are, which holdings represent the greatest risks, how your risk is distributed or not, so that only from there you can really start developing a strategy and take decisions as to what to do next. It's also from this baseline that you can start tracking the progress you're making. To give you a little bit of a sense of the insights such an analysis will bring to you, I want to share with you some excerpts of the kind of carbon footprint analysis we do for our clients. Next slide, please. So in sort of a summary, we will look at, and what you're looking at here, the portfolio is basically the equivalent of the S&P 500. And then as a benchmark, I chose here a Paris-aligned equivalent of the S&P 500. And so what you want to compare it to a benchmark so you know how your, what that order of magnitude of what your portfolio really is. We will show you what's the number of companies are actually disclosing emissions. And for the S&P 500, we're in luck, it's a higher percentage. We're then going to look at the emission exposure in terms of scope 1 and 2, which is the direct and next indirect kind of emissions of your portfolio compared to the benchmark, and then also include scope 3. Very important is then to look at the emission intensity in a relative way, to sort of look at what your carbon footprint is as to $1 million invested, so as it relates to your portfolio. And finally, we also look at the carbon risk rating, which is really your climate performance. Carbon risk rating is a proprietary measure by which, in a forward-looking way, we look at how companies are actually adjusting to change and are on the pathway to change. That then gets nicely summarized in a little chart on the bottom left side, portfolio vis-a-vis benchmark. And again, scope 3 is always the largest measure, also the hardest to come by, and then give you a sector contribution to emissions. No great surprise here, utilities tend to give you the largest contribution. Again, this provides you like an overview. Next slide. From here, you then start drilling down into individual holdings to really identify the laggards. And here are two examples of this, of how to look at this. One would be to look at the top contributors to portfolio emissions. And this really is a combination between overall emissions as well as portfolio weight. And what I would want to point here to is, one is obviously the total percentage in terms of contribution to portfolio emission, which at the top, with 6%, you have energy. The other part that's really important to look at too is carbon risk rating. So not only is energy the largest contributor, but it's also a laggard towards carbon risk rating, i.e. it is slow to change. Compare that sort of towards the middle of that block to Nucor Corporation with 3.3% contribution. That is actually an outperformer. This is a company that's really taking the issue seriously and it's doing things about it. So I'm less concerned about the fact that they're non-reporting, and we'll get to that a little bit later why. But you probably are in that whole list least concerned with this company. Just as a quick top-down look, doesn't mean that you would stop there. The other way to look at the portfolio and sort of the laggards is by looking at the top emission intensive companies. And here you really want to compare that to your peer universe. How does for example, you have an Evergy stacking up worse against its peer average. This becomes much more pronounced when you look at CF Industries, which is much above its peer average. So those are the kind of outliers that you want to look at and you want to know of to then start deciding what are the conversations you want to have with your managers. Do you choose to engage? Do you choose to invest? Those are sort of the starting points. Now, to keep this brief, what are some of the major challenges with getting to a consistent carbon footprint analysis? And I want to then afterwards really hear from Jeff, because he's certainly facing that, as I'm sure likely many of you have been facing as well. One big point is that companies on the large are really not reporting carbon emissions. Overall, on publicly traded company, about only 25% are reporting. And yes, it is hard work, I understand this, yet at the same time, it's a core business risk, so it's really necessary. To give you a sense how we approach this, and again, we do have a dedicated climate team to do this, and I don't expect you to be able to replicate this in full form on your own, which is actually a reason why a number of you are working with us. Next slide, please. We are having sort of a 5-step approach here. First, you clearly start with the self-reported data. And as I said, about 25% of publicly traded companies are reporting. But then very important is also the verification on trustworthiness of these kind of data. And we find that of the reported data, about 8% we cannot use because we really think there is very poor reporting quality. Now, what do we do given that there is so much that's not reporting? Clearly, there needs to be estimation done. But to do estimation, you first have to have a very rigorous industry classification system. And I'm not talking gigs, but I'm really talking going down to a business model level so that you can get a relevant peer universe, which then allows you to benchmark non-reporting companies against reporting peers. We will then, estimate the emissions of the non-reporting companies. And, we use a lot of, over 800 subsector specific models really to get as close with a high confidence level to the estimation number. And finally, we're allocating the emissions to the portfolio and really use the ownership logic in line with the greenhouse gas principles. This addresses our work in the publicly traded space. We take a very similar approach for private asset. And all I can certainly say, and I think, Jeff will underline this, carbon footprint is not easy, but it's an essential starting point that I hope many of you have taken already or are planning to do. And with that, let me hand it over to Jeff, who's actually been going down the road and faced a number of the challenges.
Awesome, thank you. It's a pleasure to be here today. Yeah, I wanted to share a little bit about our journey. We made a net zero commitment in April and are currently working on our first ever sustainability report and starting to contend with a lot of the issues that Ariane had spoken about. So for some background, Arizona State University is a large Research One institution. We've got about 134,000 students. We've been ranked #1 in innovation for 7 years in a row. and recently ranked #1 by Sierra Magazine in their Cool School Sustainability ranking. So these are things that are really core to who we are. The university reached net zero greenhouse gas emissions on Scope 1, Scope 2 last year. And we're getting ready to unveil what we call our Global Futures Lab, which we've built as the medical school for the Earth, really trying to tackle some of the pillars of climate and water scarcity and food scarcity. And so, this topic with our endowment is really important and really at the center of the university's ethos. So as I mentioned, we made our net zero pledge for 2035. And that aligns with the university's goals on Scope 3. And if you kind of think about it, right, the investments or the finance part of them, include the investments of us on Scope 3. So that's where that alignment really came from. And part of the idea is that we know that this is coming, right? There's an urgency to what's happening, and I think one of the comments that's been made, right, is we don't have all the answers today, but we need to be willing to make a stand and start moving towards it. So for us, our journey was really interesting in that I think what we were being asked for from the university and other stakeholders is really more on the divestment side. And in hindsight, maybe it would have been easier if we just went along with that, because that's pretty black and white versus the net zero approach. But ultimately for us, it was really a more holistic way of thinking about things. I mean, Ariane showed, that the biggest contributor to the portfolio that she was showing was the utility side, which again isn't really incorporated in a simple fossil fuel divestment strategy. So we thought it was more important to think about, a net zero approach than just going simple divestment. It also was more consistent with our charter, which talks more about focusing on what we include and not what we exclude. Our investment committee also had some aversion to divestment, and so we making progress on the sustainability front. If that was a starting point, would have been a challenge. So thinking about it more from a holistic net zero approach, allowed us to get more traction with them. And then probably like a lot of universities, we have a lot of academics that have a voice, and especially from our finance department, any approach that limits the investment universe, results in a suboptimal outcome. So again, this idea of a simple divestment was hard to get from. And then increasingly, as we think about this migration or this transition to a net zero portfolio, having a voice as a shareholder is important. And again, in a divestment side, you lose your voice with proxy and engagement and other things like that. So that was important too, and why we went more the net zero route. And then lastly, and this is something that we'll probably talk about more, is again, at our university, we have a lot of expertise on carbon capture. And even though we haven't made any investments in any of those companies directly from the endowment, we see that as an area of competitive advantage, and again, central to who we are and how we're trying to solve these problems broadly, and like that net approach rather than a simple divestment side. So really for us, how we were able to make the step then is ultimately tying it to our fiduciary responsibilities, right? Climate risk is investment risk, and so from a risk perspective, this was an important thing to do. And then similarly on the upside, that the ongoing energy transition really presented an investment opportunity, and so there were returns to be had. So as I said, we made that commitment in April, and really for us, it was very clarifying. When you talk about ESG, you've got the E. And what do you care about with respect to environment? And so again, this net zero idea became a lot easier to rally behind as we think about our investments and our shareholder engagement efforts, and then again our measurement going towards this net zero side. And ultimately, again, this is not easy. So where we are today is thinking about the definition. What does a net zero portfolio mean for us as an endowment at Arizona State University? How do we think of it in a multi-asset class portfolio? We'll dive more into that. How do we measure it, which is obviously the purpose of this discussion. And then what are our interim steps between now and our goal of 2035 that get us there? So even though we haven't made an explicit divestment statement, what I think is interesting as we have gotten better at ESG integration and other things along the line, is that you're seeing a natural dip in fossil fuel exposure as a result of those efforts. So we haven't made a new private fossil fuel investment since before I joined. When I joined in 2017, our fossil fuel exposure was about 6.1%. Now it's dropped to 2.9%. And we've got no direct thermal coal investment. So again, we're starting to see the output, the results of our portfolio consistent with this idea of I think what we all want to see, but without an arbitrary divestment policy and thinking more holistically. So, as I mentioned, we're working on our first endowment report right now. There's so many acronyms out there. We've decided to use SRI, but to change what it stands for to be more innovative, I guess. So we think of it as sustainable responsible impact. And that's we think an all-encompassing term that is able to reflect all of our different efforts in this journey. And part of doing it, again, is that transparency we think is really important. No one's necessarily asking for us to do it, but we think that it's important in our role as a transformational catalyst to be willing to show the world what we're doing, to talk about the challenges, to benchmark where we are and where we'd like to go. And so, that report's coming out in the next couple of weeks. We've got 2 endowment pools. We have our traditional endowment that's about 1.1 billion. And then we've got a smaller dedicated SRI pool that we created a couple of years ago with about 180 million. And again, on the reporting side, we've decided to focus mostly on our dedicated SRI pool as for our first pass. And even that's been a challenge, right? It's a mostly public portfolio. Currently, we're just starting to get into alternatives in there. Everything we've put in there has been with the lens of sustainability. We don't have legacy fossil fuel investments. We don't have a lot of private stuff, but we're still struggling with reporting, right? Even with that said. So we work with BlackRock in an OCIO capacity. They've helped us a lot with carbon intensity measures. They've helped us with roll-up ESG scores. We internally have been using Bloomberg to try to get other metrics. And similar to what Ariane spoke to, we've had a challenge with coverage. As she showed, the S&P 500 might have 70% coverage, give or take, but you go, bigger in the U.S. and into smaller stocks, and that drops. You go into emerging markets, and that drops, and so we're seeing coverage in our portfolio of less than 50%. Again, in a pretty simple portfolio today. We're starting to think more about then how do we do that. We try to look to our managers too. I think one of the things that we've tried to think about from the portfolio is that there's many different layers. So there's our practices. So how does ASU and the ASU Foundation think about our role in an approach to net zero? Then we look at our key partners, our BlackRock, our OCIO, and others, and what are they doing as a firm? And then going to the managers that are investing money on our behalf, and what are they doing? And then finally with the end companies that they're investing in with the actual capital. So, at the manager level, what we've seen is that, most of the managers in our portfolio have explicit policies on limiting their own carbon footprint. I think all of our managers in that portfolio are PRI signatories. So looking at some of those non-parametric things. And then one of the things that we like is that I think over 80% of our managers use ESG metrics as part of their employment reviews. So, that's becoming more central to it. And then again, going forward, collaboration is so important in here, right? And I think that's a big lesson. I mean, even in the work that we've done prepping for this meeting, really impressed with some of the stuff that ISS is doing. So how do we work more closely with them? A lot of you probably seen a lot of the announcements that BlackRock has made on the evolution of their climate Aladdin system. There's a local carbon accounting software as a service firm called Persephone. ASU alum is the CEO that's doing a lot of work in that using AI and again, trying to bridge the gap that Ariane was speaking about on reporting and usability of data. So we're starting to talk to them. But this isn't easy. And so, we're trying to think about it. Right now, we're in the process of defining what net zero means to us. Again, our portfolio is the university scope 3 emissions with that category 15 financed emissions. And I think it's important for us to realize that this isn't a linear path. So from here to 2035, it's not that every year we're going to have a certain tick off in emissions. We're thinking about what does that journey look like, and what is our climate action plan. And then right now we're ramping up resources on engagement. So we created a proxy voting policy. We helped create a student group that they call Sci-Fi Student Initiative Finance Impact. And they're looking at a lot of efforts around engagement and proxy voting on our behalf. They're working right now on an engagement with Chevron in particular around their practices. And so as a lean team, we're trying to make use of those stakeholders in a twofold way, right? What they're helping extend our reach, but then it's also very educational and impactful for them to see what can be done. So maybe I'll pause there and hand it back over to George to start filtering through all the questions that have come through.
That's great. Thank you so much to you both. And for participants, just a reminder to please do put questions in the chat. We're just going to shift into dialogue mode here so we can pick those up anytime. And thanks to you all for sharing questions as you registered too, because we've got a lot of great ones. So we'll jump into some of those while we wait for some to come through live here. But Ariane, I want to kind of come back to you, and you talked about how the carbon footprint can kind of give you that baseline and identify some of those hotspots of high emitters, and how can investors then use that to think about how they either engage with those hotspots, or do they divest from them, or start dialogues with their managers around that? How does that sort of inform action?
So often happens in this world. Someone stays on mute. No, absolutely. And it really depends on the individual's situation of the investor, of the portfolio, size of portfolio, what kind of strategy are they setting, have they made a net zero commitment, what kind of sensitivity is around there, how big is the portfolio, if you're a universal owner, divestment is really not an option, even if you wanted to take it. So that aside, it helps you by just seeing, first of all, looking at a benchmark that is in line with what you're trying to achieve is obviously really important, so that you know how your portfolio performs to an ideal state. And then you start looking and saying, okay, what keeps me away from that state? What is sort of the sector allocation? What seem to be the major sectors? And then, who are, and that was a little bit the slides I referred to earlier, who are sort of the worst offenders and what's a little bit their profile. And you can then, obviously, there are data below that go even deeper into the individual companies so that you can really compare them on a peer basis. Where are they really doing poorly? Where should they be performing better? So again, depending if you wanted to do the engagement yourself, you could sort of say, okay, who really, if they were to improve, would really move the needle? And what does it take for them to, what's the business case and what does it take for them to improve? So you have the basis for the dialogue, because as we all know, in engagement with companies, it's really important to talk in a partnership way. It is not just bashing and saying you're doing terrible and you have to do differently, but it is, this is what you're not doing right. This is what your peers are doing better. And this is why this is important. And here are some ways how you could do this. So you could use it for that. You could also set yourself a target and say, okay, what are we expecting as a response from the company? And at what point in time, may we use the leverage that we have the option of divesting? Now, this could be either as a signal. So if you're a very large pension fund, for example, that obviously takes more gravitas than if you have $100 million. Even though it shouldn't change the stock price, but it just has a signal effect. So, the messaging around it. So that leverage of saying, ultimately, if you do not engage in the dialogue with us and show us some progress at some point in time, we will choose to divest. We first vote against your directors, but then eventually we choose to divest. The other side is that from a risk perspective, you may say, and you're not a universal owner, so you can in effect divest. You may say from a risk perspective, this is a risk I'm no longer willing to keep on my books, because I see the, let's say, the risk of carbon tax. I see, whatever risks on the regulatory front are coming, this is going to have a huge price risk on my portfolio. So then start making the divestment decision. Now, likewise, you may talk to your manager because, let's say, either you don't engage directly and or you also don't manage the money individually. So you engage with your manager, you share and say, this is climate risk is an important measure. How do you feel about this? Are we, seeing this similarly? If so, help me understand, why are you owning these, worst offender companies? Give me your sort of risk reward kind of reasoning. And are there alternatives? Can we look at alternatives? Again, you're starting a dialogue with the manager, and a manager may, it depends again on their style. If they're sort of a long-term hold, they may very well agree with you. If they're much more of a momentum player, this is going to be harder because they may just look at it from a pure momentum point. But I think, again, it gives you something in hand to sort of say, help me understand, this is the peer universe. Here are 10 other companies that are doing much better on these climate metrics that seem to have, a similar sort of price performance relationship. Why are you not changing this? Or help me understand. Again, it needs to be done as a partnership because you've picked the manager for certain reasons. So now it's really just more fine tuning. So those would be, clearly the ways I would look at that. And again, never forget, you have the option either via voting guidelines to your manager or because you do take voting in-house to use, your vote against directors to, get companies to pay more attention to the degree they don't.
Yeah, I just say, I think, the adage that what's, measured is managed is so important, right? So we got to know where we are. And even though we've been, pretty resolute in not going a divestment route initially, I think it's going to be hard to get to net zero by 2035 without that as part of it, right? So I think for us, and this is what we're working on right now, is, first phase is measurement and starting to engage and think about it in that side. As Ariane said, there's a powerful messaging thing, right? I mean, telling all of our managers and sharing with them that we've made a net zero commitment by this point, and if they're not thinking about that journey with us, then it's going to be hard to include them in the portfolio in the next 15 to 20 years because they're going to be keeping us from that goal. Similarly, and I think that report that Ariane showed demonstrates the challenge a little bit. Is you probably have it, and I'm somewhat estimating, but 10% of the portfolio makes up 90% of the footprint. So it does get to be some low-hanging fruit at some point to make big waves towards that net zero side by moving out of some of these names if they haven't done more, right? On the utility side, if they're not starting to move more towards renewable sources of power for electricity and things like that, and there's not a journey there, then there's going to be a point in time then to cut them off, and that's what we're trying to articulate and quantify right now for us when we are in that journey.
Yeah, so we've got a couple of related questions in the chat. Ariane, coming back to you. Well, first is one around CDP data, and do many people use that? Is it clean enough for investors? And then also want to get into the Scope 3 question about how you estimate Scope 3 emissions. And as you sort of said, as you look at the underlying companies and the products and services that these companies are generating, that might well be climate solutions, even if they have emissions involved with the production of them, or vice versa, as Jeff is saying, with some of the heavy emitting kind of oil and gas operations that might get to net zero with their own operations, but their product is not contributing to the solution. How do we think about that?
Yeah. So, I mean, first of all, CDP data, absolutely, they're good data to be used. So no reservation there. We use them sometimes because sometimes, if we can get them from the company and we can get them from CDP, we have a similar format. So yeah, would completely underline that. In terms of Scope 3, it's actually a really interesting question. In general, if your production is carbon intensive, but let's say your products and solutions reduce carbon emissions on other companies, generally the impact of your production is going to be much less than the benefit sort of your purported scope 3. So, you know, from that side, there are few, I can't actually think of an exception to that. I'm sure there is one, there's never no exception. But in general, you can be comfortable that the benefit will far outweigh the negative parts of production. Now, here are some other things to think about. Let's talk about electric vehicles, EVs. There really, it depends a lot on where you are and how the electricity is produced to create your EV vehicle. So there are certain states in the US where I would say the benefit of the EV vehicle is more than offset by the negatives of the way electricity is produced if it's done via coal production. And there are states where the energy mix is quite different, where I would say absolutely there is a benefit. So, you know, you need to sort of then go a little bit more nuanced and not go just by the headline of saying electric vehicle, always perfect. You know, it does still need electricity. So what's the source of electricity? Jeff, anything to add to that from your side?
No, I mean, I think that's it exactly. I mean, again, that gets really complicated really quickly, right? And again, I think this is part of what we're trying to think about when we talk about a net zero portfolio, is that, you know, net zero on scope 1, scope 2, or scope 3 emissions, or all the above. You know, as I mentioned, you know, we're the university scope 3. So then how do we think about our portfolio and how far down that trail do we have to go in measuring these things? And again, it's not easy, and nobody has all the answers today. And that's partially why we have a, you know, decade plus long runway. And again, it gets, you know, some of these things get complicated too when you start thinking about savings, right? So on the EV side, right, like you got to net out some of the positives with the negatives on it, and how do you account for that? Or, you know, there's a local firm that's doing alternatives to plastic. It's a material science firm that's doing packaging with fiber instead of plastic. So again, they probably have a positive carbon footprint, but if you think about the alternative, they're saving a lot. So how do you account for things like that? So these are all things that we've got to contend with in you know, getting that net zero stamped of approval someday.
Yeah, and it's really, I mean, at this point in time, you know, so few companies report scope 3, and it's really, it should just give an order of magnitude. And I would say that from a risk perspective, you know, you shouldn't use it for investment decisions. Right. It's more from scenario alignments, because within the budgeting framework, it really does work. That you really should look more closely at it. And again, that's today's state. I mean, this is evolving.
If I want to pick up a little bit more on the kind of complications and how you communicate those to stakeholders, and then also come to a question we had in the chat about the student groups. We'll come back to that. But, you know, we talked about the report and some of the complications, and like the reduction of the carbon footprint might be non-linear, but our stakeholders looking at, you know, year to year, what's your carbon footprint of the portfolio? Is it always getting better? And how have you started to think about how you might communicate that?
Yeah, I mean, I think one of the things is that, you know, universities and asset owners tend to be risk averse, right? So, you know, as a leader, it's easier to get stones thrown at you if you're out in the front. And you know, I think that was one of the challenges we had to overcome is having willingness to plant our flag with our commitment, knowing that we don't have all the answers. One of the things that really struck me in this journey was speaking to Kate Murtaugh from Harvard. And her sharing some of their challenges and questions, and it was kind of an epiphany. Like, if Harvard, with all of their resources and scale and insights, haven't solved all of these things today, like, why should I think that me and my 2-person team has to do it and have all the answers? So that took some of the pressure off, and thinking more about again, what are the action steps that we can take? How do we get to the commitment? How do we align with the university's broader ambitions and be able to report on that getting stakeholders comfortable with what that means, and then finding allies at different parts of the institution, whether it be faculty or the operations side or within our board. And I think some of this just starts to take on a life of its own. One of the interesting things that came out, we made our net zero commitment. University's been plugging on all cylinders, and when that #1 Sierra Club sustainability ranking came out, then all the questions started coming like, well, how do we preserve this? Like, how do we stay #1? And what are the things you need in order to make your net zero commitment or succeed in your journey on the net zero commitment to keep that #1 ranking? And all of a sudden, instead of having to push some of these things through, it's, like all these resources are now available and support in doing that. So again, I think there's power in taking that first step. And so for us, again, I think it's hard to, what does the number mean, right? We're gonna come up with a carbon intensity number, and we've got to benchmark it, like Ariane said. Okay, so we're doing better than the ACWI. But again, I think the value then is being able to show that year over year and showing the progress. And hopefully, that number is getting smaller and smaller, and the delta to the benchmark's getting larger and larger. And that's a lot of how we're starting to think about it.
It's great on the stakeholder engagement and kind of mentioning how faculty can help and the like. I just want to take this quick question from the chat around the student initiative you mentioned, and they're asking how is that group formed and what kind of level of engagement do they have with you on a regular basis?
Yeah, I mean, so we try to have a tight relationship with that group. Our president likes to say that while higher ed only makes up 2% of the carbon footprint, we make up 100% of the learning imprint. So again, it's I think really core to us to have this idea of experiential learning as part of the university experience and things like that. So it's a independent group of students that formed and created this formal club. I think there's 20 or 30 students that participate, and they work on their own priorities and their own themes and their own engagement. One of the things that we do to try to work with them then, though, is as they do come up with engagement ideas, we've got a student managed fund that's got a sustainability mandate. And to the extent that we've got that capital, we could buy shares in some of the companies that they want to engage with. And then obviously, they're going at it at a very different, path as being a direct owner rather than, just some student group. So we work really closely with them. They actually helped us create our proxy voting policy. So again, I've got a really small team. So, we were able to use that group to help us articulate, some of our ambitions and goals. And then even though we don't have a lot of direct ownership today, that proxy voting policy has been really valuable in how we engage with our managers. It's a good way of talking about how we expect them to be voting on our behalf. It's a good catalyst to ask for their voting record and see where there might be alignment or misalignment with our thoughts and looking into that. And then again, the engagement side is, really evolving. Many people might have seen the news that BlackRock can start allowing you to vote your commingled iShares. We're starting to look more and more about going back to SMAs where we have more direct exposure and being able to vote on that side. Firms like As You Sow are really helping streamline the process. But again, for us, we've been able to use those students in an important way there, and we're starting to talk to them about voting proxies in our student managed funds on our behalf, and again, trying to do a lot of the things, take the first step in a lot of the pathways that we want to go in, but might not have the resources today to do so.
And I would think you're seeing enrollment at the university increase because it's so great for you to involve the student body this way. This is really terrific.
Yeah, I mean, I think one of the things that's been different here, is that we don't have students, chaining themselves to my door and rioting and picketing on these things. And I think part of that is, again, the ethos of the university is so tied. And then again, we've been willing to engage with these stakeholders in different ways in more productive avenues, right? So it's not just, reacting to the topic du jour, but really thinking about a strategic approach to engagement or divestment or whatever it might be, and hearing the students in that and giving them the voice in what that path looks like.
Actually, on that note, I want to put in a plug for the student managed fund competition that we've been hosting the last couple of years, which the ASU team won last spring. Congrats again on that. But that's another great way for student managed funds from different institutions to connect with each other, learn from each other, and get some real world experience. So for participants, if you have student managed funds on your campuses that might be interested, do let us know. I don't want to shift. We've got a couple questions that we're also going to get to in the chat here around how you account for short positions and do they offset longs in this kind of conversation around net zero, and maybe somewhat related, how do we think about carbon offsets and sort of when they come into play and thinking about a net zero portfolio? So Rhiannon, you want to pick that one up first and we'll go to Jeff?
All right, I'll start and then I'll hand it over to Jeff. So very hot topic and a very timely topic. So I think we need to think about from a shorting point of view and its effect. Are we looking to a risk factor, a risk mitigation, an accounting effect, or are we looking at impact? So, shorting can certainly help manage climate risk. It can be expressed via greenhouse gas accounting, so that's doable. It potentially, theoretically, can have a positive impact on climate, but it really, you cannot calculate this impact via greenhouse gas emissions because, again, that's a question of ownership. Can you control it or not? So, that's why I think one needs to, it is certainly a way to mitigate climate risk in a portfolio. So let's say you have company A and it's a really high emitter. You want to engage with them, but you really don't want to take the risk. So you may, on the other side, short the company. So you have now basically offset your exposure, but you still keep influence with the company. You can still vote the shares. And to the degree that what you think is happening, i.e. the company underperforming, you're benefiting through your short position. So you've in effect reduced your risk. So one should definitely make sure that there is no double counting from an accounting point of view of, greenhouse gas emissions, that you don't double sort of the exposure. But, have you taken greenhouse gas emissions out of the atmosphere just because you've shorted the oil company? No, they still continue to produce. So from an impact point of view, you really haven't affected anything. You're still holding on to the company, and that's your positive impact, your positive bad impact, and the short doesn't affect it. Now, different would be, and then I'll sort of stop it and hand it over to Jeff because he'll talk a lot better about the offset side. Different if you now, let's say I own that terrible emitter on one side, and I also invest in carbon offset, mechanisms, in carbon capture or the likes. Now I've really done a positive reduction of greenhouse gas emissions while I'm still holding my greenhouse gas emissions as an owner on the other side, or I may decide to divest or whatever. So from an impact point of view, to get to a positive side, you ultimately need to invest towards positive strategies. And with that, let me hand it over to you and get off my thin ice here as carbon capture is concerned and hand it over to you, Jeff.
No, I agree with everything you said. I think on the shorting side, again, I think it's interesting to think about, what are you trying to accomplish? So similar to divestment, if the theory is that by divesting, you're increasing the cost of capital for the firm, the same could be true of the shorting side. And so that's got a negative, financial impact on the company that's maybe a bad emitter. But exactly as you said, though, it's not changing the actual carbon in the atmosphere. So, I think that's a perilous one to think about, that you're, shorting the fossil fuel company is going to offset the long that you might have in a different one. But again, there's the cost of capital one that maybe as a short-term step does have some value theoretically. And then I agree on the carbon offset. I think it's a little bit different of a story. Again, you get into the quality of the carbon offsets and accounting and make sure they're not double counted. And that's where blockchain and a lot of new technologies are coming around on that front. As I mentioned, we're doing a lot on the carbon capture with a device we call a mechanical tree, which is an installation that is kind of got the grandfather of carbon capture as a faculty here, and starting to think more about how do you monetize and productize something like that, and how does that start to work on the offset side. So I totally agree. I think that at least, maybe not at the end goal, but at least along the way, I'm starting to think about the offsets as a way to reduce the net emissions, is part of, I think, that pathway that we're thinking about. And then again, shorting, it's relevant, and we've got a long short portfolio and things like that, but I don't think it's as simple as taking it's not as simple as netting those off on the scope 1 and scope 2 emissions.
Got it. Thank you. So we've got a couple of questions now on private market and how you measure and approach those. So one is just, how do you approach the measurement in that area? And then a second related one, maybe for you, Jeff, is what are the return requirements, generally speaking, that you have for private equity climate strategies and private debt climate strategies?
Yeah, so I'll start and then let Ariane think about some of these things. I think the multi-asset class portfolio is, again, another one of the confounding challenges in what we're doing here, right? So you've got both the stock and bond side, right? So how do you account for the carbon impact of different investments in different parts of the cap structure? And again, I don't have all the answers there. I think conventional wisdom is thinking more about scaling it by enterprise value and things like that to accommodate a bond versus a stock, and thinking about that side. And then again, you've got the complexity then of public versus private markets, and I think that becomes more about just readily available data. It's I think to Ariane's point earlier, there's a lot of S&P 500 companies reporting this data. There's not as many small privately held companies that are doing it or have the scale to do it. So I think that becomes more the challenge, is just the availability of data. I think you would treat a private credit the same way you think of a public credit, and you think of a private equity investment the same as a public equity. Just getting the data that's harder. So I think that's part of, again, where the manager discussions come into play, is finding managers that are asking that of their companies, or are doing that analysis in their investments, and are making that readily available. Because again, it's harder. Can't go into Bloomberg and get the carbon footprint of a privately held company. So that's a bigger challenge. On our return requirements, on the private markets portfolio, we tend to have a barbell approach, I guess, a little bit. So we have more infrastructure. So we've done renewable power and things like that. And that's more of a stable, high single digit, low double digit return, lower risk, lower return, and then offset with kind of the more growth venture-y private equity, which is going to be in the higher teens assumptions. And as fiduciaries, we're not looking at anything with concessionary return. So with this money, we're looking at everything that has a commensurate risk and return. And so that's kind of how we structured the portfolio, and thinking about it that way. And as I mentioned earlier, I think as we go forward, these are places where there is huge growth, and the companies that are solving these issues, as everybody's trying to contend with it, are going to be very profitable and make us a lot of money. But right now, we're not willing to give up return for that impact in this pot of money. We've got other more mission aligned capital that maybe we're willing to do that. But in the endowment, we've got our fiduciary hat on first and foremost.
Yeah, and I think the only thing I can add to that is really to underline, in the private market, it's that much more that you have to work with estimations. Estimations are only worth it if you have a very rigorous business model, scaled, approach. And it does take more effort to do it, because it's just, you do it sort of more company by company. There is no portfolio upload in that sense. And that's just the state of the industry right now. Will this improve over time? Yes, but for right now, that's the only way to approach it.
Got it. Great. We've got a couple other kind of related ones that are about sort of first steps, getting started, and priority steps, I guess. So one is, what are the first 3 steps that a foundation or endowment should ask their portfolio advisors or managers to take to begin screening or assessing net zero emissions across the endowment? And then kind of maybe after that, in priority order, how can a CIO reduce the carbon footprint most efficiently? Is it low carbon passives, other asset class opportunities, or are there places to start? And maybe this is building off your kind of baseline hotspot analysis, Ariane, but where do you kind of get the biggest gains early on in terms of emission reductions?
You want to start, Jeff?
Sure. I mean, where we've started on kind of the reporting side is, I guess, twofold, right? Is as we've talked to our managers, we've tried to leave it open-ended. We want a report on your ESG metrics, carbon in particular, and kind of left it to them to how would they start to get their arms around the portfolio and the impact, right? And that gives us that's given us a better sense of what metrics do we like, do we not like, what does coverage look like, what's the best way? This goes to one of your other questions, George. What are things that resonate, that as we're talking to stakeholders that just kind of make sense better than others? So we've kind of done that at the manager level, and then similarly with BlackRock, who's our OCIO, is kind of put the onus on them a little bit on how would they start to report on the portfolio as a whole, since they've got the portfolio mandate. So thinking about how would they get their arms around reporting on these things, and then again that becomes a discussion on what more do we want to see, what are we not getting that we think is important, what are metrics that maybe we have access to that they don't, that we could report on, or vice versa. And this stuff is moving really fast, so what's kind of the up and coming metrics and things like that. But that's kind of how we've tried to think about that question. Is we're not the experts, so trying to really use a wisdom of the crowds approach to see what what all of our managers and consultants are doing, and then looking at our peers and how they're reporting on these things.
And I would add to that, and I think that's what you're also doing, Jeff, and out of that, then ultimately deciding on sort of what are the metrics that you want to see in a report, just so that you can compare managers across each other. Yep. And see a little bit how's the progress they're making, and for your own reporting to report out the progress that the endowment is making.
Yep, exactly.
Yeah. So just got a couple of minutes left, but picking up on this theme of engaging through managers, we had a great question in the pre-registration about how do we make this less intimidating. Jeff, you spoke to it a bit about kind of making the commitment, and the field is working this out, and I think we see lots of great initiatives like the Net Zero Asset Managers Initiative. There's now the Net Zero Investment Consultants Initiative. So the service providers are, getting on board and can help make it easier for asset owners to make these kind of commitments with confidence. But one of the ideas that I find helps simplify this is just looking through and having a simple metric of having all the underlying companies adopt science-based targets or decarbonization pathways that are aligned with Paris agreements. And if that's happening, and managers and asset owners are able to stay engaged and kind of keep on top of those companies to make sure that those pathways are being followed, then the portfolio itself is on a decarbonization pathway to net zero. So I'm just curious, can it be that simple? Can we think about it in that way? And is that a good way to help make it less intimidating?
And I'll jump in first, and I totally agree, George. And I think that's part of the non-parametric way that maybe does make it easier to compare investments across asset class and public-private side, right? Is some of those things, is the manager doing X, and so I think that obviously that's not going to get us all the way there, but that's a good first step, right? And it's another good engagement idea, right? Is as we're talking to managers, saying, what are you doing? How are you committing to this, right? Not just how are you reporting, how are you integrating it into your investment process, but what is your pathway going to look like? So I think that is a kind of a natural way of doing it. And if, again, to your point, if all managers ended up doing it, that's going to go a long way of sending a message to the underlying companies, like we better figure out what we're going to do, or nobody's going to put their money into us anymore.
Yeah, no, I fully agree. I mean, that's when, when we look sort of at our Paris aligned benchmarks as, index portfolio possibilities, yeah, the companies underneath it are there. Yeah, that's what the selection process does.
Perfect, perfect. Well, we are at time. I want to thank everybody for participating today and all the great questions. Sorry we did not get to all of them, but do be in touch. I'm sure Ariane and Jeff would be happy to follow up over email. And to get in touch, you can just email me at George with an S at intentionalendowments.org, which is on our website too. But a big thanks to Jeff and Ariane for all of your insights and sharing your stories today. And looking forward to keeping these conversations going with all of you.
Thank you, George. Thank you, everybody.